Okay, I think I can finish this topic up in this fifth and final video. Let's move on to the next thing. I've talked about what happens with the excess. Please, I'll give you an example anyway when I send the email that you can do that will help you play with this issue of excess. Because remember that you might have to, first of all, extend bands and do everything. So it's about the top slice, and then we just have to work with what we have. Here's an actual example. Where was I? Yes, this is an example. This is in your textbook, so I was going to do this. I won't do this now. This is in your textbook. It is on page 374. And so you can have a go anyway, and we can look at it in class if you want. But we will do questions that will cover this anyway. I'm going to move on to a final restriction, or two final restrictions, so to speak. And this is about even a further restriction on the annual allowance. So you can see that, first of all, we have relevant earnings as a restriction. Then we have annual allowance as a restriction, of course, with their quirks. And then finally, we have a restriction on the annual allowance. And as you can imagine, the government are obviously trying to prevent high-income individuals from taking advantage, so to speak, of these pension fund reliefs. So, first of all, the lowest the allowance can get to is 10,000. So everyone, as long as they're earning, as they're working and earning or whatever, it can fall as low as 10,000 if you want to start adjusting their annual allowance. So that's the, if you like, the floor, so to speak, that it can reach. So it says the annual allowance is gradually reduced for individuals with high income. So this restriction applies to individuals with adjusted income, and I'll talk about what adjusted income really means in a second. Adjusted income exceeding 150,000. So what happens is you have the adjusted income. What you have is we get that adjusted income. We take 150,000. I mean, you have to be pretty much earning quite a bit. Adjusted income minus 150,000 and take 50% of that. And then, we just keep coming. So for example, I don't know, say for example you earn 180,000. And if you like, or let's just say 170,000, so we don't hit the 10,000 marker. You earned 170,000. Well, when I say you earned, your adjusted income was 170,000. Take away 150, we have 20,000. Take half of that, and that half of that, of course, which is, if you like, 50%, is equal to 10,000. So that 10,000 becomes what we adjust your annual allowance by. So your annual allowance will go from 40 all the way down to 30,000. That's what we're sort of arguing here. And we're saying that this can get up to an amount where, you can imagine that we're saying that you must always have 10,000 left, whatever, even if this was, I don't know, whatever, 250,000. So you did 250,000 minus that, and you did half of that. That was 50,000. Yeah, 250 minus 150 gives you 100. 100 times a half gives you 50. You don't totally knock this out. You restrict it to just taking off 30 because you're always allowed 10. So you're always allowed 10. And the question is, how do we arrive at this idea of an adjusted income? So first of all, of course, we have your net income from your income tax computation. So your net income with all your whatever savings and dividends, everything together. Then what we do is we add on any individual employee occupational pension contributions, right? So if you like, anything you've contributed so far and what your employer has contributed as well. So we add that all together. So if you like, this is your total, because of course your net income, as you can imagine, excludes your occupational pension contribution. So add all that together, arrive at your adjusted income. So in a way, this is kind of different to when we did the adjusted net income earlier on, where you took off pension payments and gift aid payments, gross. No, this is kind of the reverse. We're actually just making sure we have your employers on there as well, and that's what we call your adjusted income. This is just confirming what I said earlier on. And this is, again, like I said, this is just confirming what I just said. And finally, what we also have is this idea of a lifetime allowance. You are only entitled to put through £1 million overall. You're not examined on tax charge if you put over £1 million. So over the life of your pension fund, you're only allowed to put up to £1 million. Anything over that becomes chargeable to tax. So yeah, great. So I think the figure you need to remember, this might be a written thing in terms of advisory. If someone says I have 1.5 million, you're saying, well, as at 2016 and 17, it was £1 million. But hopefully, again, we'll see questions that force us to discuss these issues. Yeah, great stuff. And this pretty much comes up when it's time to kind of draw the pension out. All right, okay. So just a couple more things very quickly that I will talk about here. And this is to do with in terms of when it's time to retire, you're allowed to draw 25% tax-free, and the other 75% is taken out as an annuity. So over the rest of your life, it's calculated a certain amount that you would need every year, so to speak. That's one more thing. And retirement age is 55. You can start drawing out your pension at 55. And I mean, this is what we are examined on right now. I don't really know what's currently happening with pensions. I know that people are able to withdraw more. There are all sorts of things people are doing right now. But as far as you're concerned, you can withdraw 25% tax-free, lump sum, and 75% annuity, and that's what you're examined on. Anything else you draw over that is taxed as though, if you remember, as non-savings income. Will be subject to the 20%, 40%, personal allowance, of course, 20%, 40%, and 45%, depending on what's going on with you. Okay, great stuff. That's the end of my 5th video. Please read up on national insurance. We will talk about it in class quickly, and don't worry so much about the next chapter on dates. We'll have to come back to that over and over again. I mean, read it, but we will have to come back to learn about the dates and see what's going on with those as we go on. Okay, great stuff. See you on Friday.